It brings us to our talk of the tape. Just how vulnerable are stocks right now? Let's ask Adam Parker. He is the founder and CEO of Trivariate Research, a CNBC contributor, and he is back with me at Post 9. It's good to see you again.
Good to be here.
Do you feel like stocks are vulnerable? It's been a rocky couple of weeks, especially for tech. But what do you think?
The earnings season I thought was, most of it's over. I thought pretty good.
Better than feared, for certain, right?
The big cap tech stocks, basically every single one of them, the 2024 earnings are higher than they were on July 1. So I think the fundamentals from the companies look okay. I think what's happening is a little bit of fear about the perception about interest rates, right? And how that means people will probably not want to pay as high of a multiple as they did a month or two ago. I think that's what's in the price right now. You talked about rates backing up, and for a long time, the relationship between the perception about rates and the price to earnings ratio was very strong, and it kind of broke in May when people said, hawkish doesn't matter, we're near the end of the cycle, I don't care if the Fed's hawkish. And now I think people are saying, well, wait a minute, maybe that's a little farther off than I thought.
Well, because even one-time doves like Kashkari today was saying, I'm not ready to throw in the towel just yet on this idea that we're done raising rates.
5 cuts are in the price by Jan 25. If you look, depending on what function you type in, I don't know any equity investor I talk to who believes that. So I think ultimately maybe people are saying, all right, they're going to be a little more hawkish than what's in some of the bond guys survey answers.
What about this idea that Leisman was putting forth today? We had him on halftime where he was talking soft landing good, no landing no good. No landing no good because that just means the economy's too hot to handle, right? We keep praising how good some of the data is as it relates to the consumer, like retail sales today. But the inverse on that is that, well, maybe that makes the Kashkaris and company be more aggressive than we actually think.
We analyze a couple hundred variables, macro variables. We put them together, and no matter how we look at it, both consumer activity and industrial activity are high but declining a little bit. Wage growth is not as high as it was. Industrial activity is not as strong as it was. It's still pretty good in absolute terms, but it's declining. So I think if you believe that continues, maybe you're okay. I think the bull case that was forming, a week or two ago when the market was kind of above 4,500 on the S&P and looking strong, was maybe people thinking, maybe we're at the beginning of a new earnings cycle that could just last several years. And so, because the market never trades for a long period of time above 20 times forward earnings. It just doesn't. So if that's right, and we don't have a correction, either we're at the beginning of a multi-year earnings cycle.
You think we are?
It's possible. Or the 24 numbers are too low, which I don't think is the case. I don't think the 24
too low. Some people are suggesting they're still too high.
I think they are. I think the consensus is they too are, but they're too high. But if the market's going to trade at 20 times, it's telling you earnings are going to be better than people think. Or maybe we're just going to slowly go higher for several years, in which case you'll be a little more anticipatory this cycle. I think that was a narrative until very recently now, the last couple of days, where people are saying, they may end up a little more hawkish than I thought finally.
You watching yields or equities more, sort of as a tell on kind of where you think we are, right? Because it's been, as I said, a couple-week pullback in tech. Market's been hanging in, though. I mean, look, even today, right? You're worried about China. 10-year hits its highest level since October. Dow's down 0.8%. It's not like we're having a major problem here.
Right. I mean, you and I were on the air together 80 times last year, where it was worse than today, right? So I don't.
You were here for like 77
of the worst days, exactly.
Out of the 80.
Yeah, so I'll take a little 80 bips, like that's nothing.
Yeah.
But I think the two things that matter the most are the perception about interest rates. So where do people think they're going to be 12 and 24 months from now, and growth. And I don't think the growth numbers have given people cause for concern. So I think it has to be this perception about rates that's causing the pullback now.